Long-term investors can choose from three main strategies: value, growth, and dividend investing. Value investing focuses on undervalued stocks with strong fundamentals, using metrics like price to earnings and price to book ratios to identify potential opportunities. These stocks may take time to appreciate, but can offer strong returns over time. Growth investing targets companies with high revenue and earnings expansion, often in sectors like technology and healthcare. These stocks can deliver substantial gains, but come with higher volatility. Dividend investing provides passive income by selecting stocks with consistent dividend payouts. Key metrics include dividend yield and payout ratio, ensuring sustainable returns. Investors can blend strategies by diversifying portfolios based on risk tolerance and financial goals. Balancing value, growth, and dividends helps reduce risk while maximizing long-term returns in changing market conditions.
David, get us started. I know that you have an approach putting together portfolios that include public and private investments. How do frameworks help individuals or even investing committees to select between value, growth, and dividend strategies?
Well, our approach has generally been what I called asset garden approach. So we're asset allocators. I did it as an institutional advisor. I do it now as we work with individuals and advisors. I think, when you talk about value, growth, dividends, the first question is, and we have, sounds like three very smart, active stock selectors. And what they do well at is identifying companies, be they value, growth, dividend, that are doing better than the consensus. My background is having spent years working with active managers trying to select them. Most aren't able to do that and identify those stocks that beat the consensus. Some do. And so as an individual investor, it's not something I've done. It's not something I want to do because I know I'm not competitive at it, because it matters who is on the other side of the trade. What do they know that I don't? And I don't believe I have the skill set to identify individual companies that'll do better than what's already priced into the stock.
Where do you fall in that asset allocation, active managers versus passive managers then?
In my case, I've always been an allocator. So if I can get the factor exposure I want, the underlying drivers are attractive, then I'll generally have used ETFs. And I did that at my old firm back when institutions didn't invest in ETFs in the early 2000s, and have found that just a more effective way to implement our view rather than allocate it to a handful of active managers that end up, and sometimes on the overall portfolio basis, they cross each other out given their particular views. And so it's sort of an active passive approach, but the active position is as part of the top-down allocation.
Mariko, you're a great analyst and portfolio manager. Chris called out cadence. That one always is at the top of my mind too. How do you explain to people the difference between investing and gambling?
It's interesting because so much of what passes for investing these days is really speculation and gambling. So, and the other thing I'll just footnote to cadence, I don't know, you guys saw that Lip-Bu Tan, who was the CEO of Cadence, is now the CEO of Intel. And I haven't done any work on it, but if anybody has the insight, he's a former board member as well of Intel. It'll be really interesting to see what he does there under his leadership, given what's all the challenges ahead there. I think for the difference between investing and gambling, I think is the approach that you take to it. So like now you have options where you can bet on whether the S&P is going to be up and down on Friday at 4 p.m. right for the day. I mean, that's not investing. I think so. I think basically if you have a longer term horizon, you're investing probably. And then, so it's both a function of time horizon and it's also a function of the instruments that you're using. So if you're using instruments that expire and are worthless, right? Options are very useful, but they're a weapon to be deployed very strategically with a very specific use. And I would say I would, use it as either leverage or a defensive hedge, right? So for me, the investing is a function of time horizon, objective, and then also the instrument as well. Like, does it have legs? Can it last long enough to recover if anything goes wrong?
Yeah, so an element of quality, it sounds like.
Mm-hmm.
Just if I could jump in, it's something that I've looked at a lot. Investing versus gambling versus speculation, and a simple definition for me is investing is something that has a positive expected return. Gambling is something a negative expected return. When you go to Vegas, you're gambling, you're not going to win, but you do it for fun. And speculation is where there's a disagreement. Is cryptocurrency speculation? Yeah, so is gold, so are other futures, but that's sort of a simple framework to think about it. If it has a positive expected return, then it's an investment.
Mike, give us some insight into one of your favorite places on earth that's working on the desk of a major hedge fund. Talk about strategy. How has your investment strategy changed over the years?
Oh, you're talking to me?
Yeah.
Well, in order to excel in the hedge fund arena, you really have to be a chameleon. It's really funny, the fixation of the managers up top, or anyone who's investing in your hedge fund. When you talk to them, they love to see that PowerPoint presentation with all the details on what your process is. And they're fixated on this bulletproof process that outperforms. And the reality is, if you stick to that process, you will blow up, because you have to reinvent yourself quite often in this business and have a menu of sort of costumes that you put on. Okay, I'm going to be this. Okay, I'm going to be Harry Houdini now. And you have to change the way that you do things in order to make money. The fixation is always on being right. And being right is not making money. They are two different things. Being right is for people who write books. Making money is for people who run hedge funds. And they are not the same thing. So you have to be steadfast in understanding that the setup that you have on right now, hopefully is a winning one, and that you have to change the way that you think and understand in order to adapt to a changing environment. And that's really what I did a lot of at Millennium, changing my process, changing how I looked at things, and always being aware on not only what the bottom-up companies are going to do, which frequently turns into earnings and frequently turns into stock performance, but also looking at what all the benchmarkers and others in the business have to do so far as benchmark weightings and so forth. And one point I'll come to right now, we've seen, for instance, a big move in the Qs, QQQ or NASDAQ. And there's been a lot of very large names not participating enough in that rally. And it is a real problem for overall markets, whether they know it or not yet.
So is it? Yeah, go ahead, Mariko.
No, I was just going to say, Robert Sutton, I think, put it really well. It says you have to have strong opinions, weakly held, right? So to be willing to change your mind. And that's not something that that psychologically we're wired for, right? Our egos get very caught up in our opinions. Process, I second your motion, Michael. You have to have a process that is flexible and evolvable, but also like has a North Star too. Like, so it's and I would guess, that there's a fundamental underlying principle under the way that you've invested that has allowed you to be a chameleon. There's a chameleon nature that allows you to be a successful chameleon, but it's not like one day you're a wolf, the other day you're a bear, you're a chameleon, right? With a chameleon nature.
Yeah, I think that everyone who does this successfully at that level, you have two types of people. You have, first of all of them have 150 IQ, but the ones that survive are the ones that have 150 IQ and represent themselves as an idiot. And if you walk into every day assuming that you are the dumbest person on earth, that's a really good start. And
Yeah.
so, I look at it like this, is that my book, even the pink book, is going to be a sea of mistakes. And that's what I'm fixated on, is my mistakes. But for some reason, at the end of the week, the end of the month, the end of the year, it has outperformed. And it is surviving your mistakes and excelling at the moment that you're not making a big mistake. So that's what I'm really fixated on, is mistakes.
Yeah, as Mike Montero says, make better mistakes tomorrow. That was a sign we had in the office. And I think, this business, you're going to be wrong a lot. You just have to be right slightly more often than you're wrong. And when you're right, you have to make more money than you lose when you're wrong. And that margin applied consistently is what will get you. But if you have a trouble with dealing with failure or mistakes, you're not going to make money over the long run.
Yes. And just give you a reference of how often you're right versus wrong. There was just a recent interview with Ken Griffin. I saw a clip of it, and he owns Citadel. And I saw a clip of it on Twitter the other day. And he talked about his best guys at the shop. And he probably has about 200 managers of the money over there. And each one has their own domain. They don't see what each other are doing. So they're all sort of independent contractors, just like I was. And he said that people that survive and excel there are right 54% of days. And that's actually a pretty low number. At Millennium, it's more like 55, just because I'm aware of the metrics internally there. I was there for a very long time. And laughably, my career is about 58 to 59% of days. My best year was about 64% of days up. And so that's the delta that you're talking about between a manager who's good versus great, is literally 3% of days up more. That's it. And that, but when you compound that, you look at, let's say, 55% of days versus 60% of days. It means that every 5 days of trading or a week, you're right closer to 3 days a week versus 2. And if you're right 3 days a week, that's that out of 5. That means that you could be compounding 25 basis points a week or so, if not more. And you compound that together, and there's your return. So it's very, very difficult to get that right and the math behind it right. But it does compound over time. And that is the difference between a winner and a loser. And one of the profound characteristics that I've witnessed and embraced is that you must approach it as if you are an amateur all the time, or as I like to say, a troglodyte, and you are a caveman. And you have to approach it all the time like that, where you have an idea what's going to happen, but the probability of you being wrong is pretty high. So prepare for it.
I love that mindset. And it's interesting, that 54% number from Ken Griffin, because I was just talking to someone yesterday who told me about Roger Federer, the tennis champion, gave a commencement speech, and he talked about he has something like an 80% win record, but what percentage of points did he win? And I think he said 56%. And the first thing that popped to my mind was, yes, and he is really good at winning the important points, those big points. He's going to win those.
That's actually what they look at Citadel Millennium, is your slug rate. And that's a big differentiator. So often people are afraid of their best idea, and they don't size it in the book because they're afraid of being wrong. Usually it's an idea that's outside of the benchmark, and usually it's something that's lower weighted in the benchmark. So for instance, one of my better ideas in the book, in the pink book, wait, I'll just pull it up right now and I'll take one up for an example. And I'm looking at it right now. Let's see, Adama, ADMA. I have about a 5% position in Adama. It recently came in about 20%. God knows why, I don't know. and it is a large position at 4.9%. It doesn't even appear in the benchmark. I think that stock is going to double. And so I am going to weigh it appropriately so that we can make a ton of money. The pink investors can make 400 to 500 basis points out of that move in the back half of the year. That's how I do it. And my peers don't, and they won't. They will not do that. Or at least I've never seen it where they will take bets like that based on their alpha. They will simply have a 1% position in this name if they think it's a big deal. And then maybe they'll eke out 50 basis points of net outperformance on the year. And that is a big reason why the performance of many of my peers are incredibly lackluster over a long period of time. They're much more concerned with holding on to their job than they are concerned with outperforming for their investors.
Chris, we look at investment strategy and how do you grow your portfolio over time consistently? What are your thoughts?
Yeah, I just want to touch on the Federer commencement speech first. I love that commencement speech. And I think Federer said that because he lost so many points, the most important thing is that you have to have a very short-term memory, because if you fixate on that point that you lost, you're just not going to be able to move on. And I think that's important in investing, because all of us are going to make mistakes, and you can't fixate on the mistake you made yesterday. You have to kind of start off with a clean slate and move forward again, especially in these times. I feel like every other year since 2022 or 2020, it's like a bull market, bear market, bull market, bear market. I mean, it's just like a roller coaster nowadays. You have to be very flexible in your thinking and being able to reevaluate things on the fly. Now I forget what your question was, but
no, strategy. I think we're getting a lot of gems. But
I mean, I think strategy for us, it's really focusing on high quality growth companies, and we tend to favor service sector companies because we feel like those are less cyclical, very sticky businesses. It's kind of like if you go to your dentist. I've been going to the same dentist since I was a kid. If you find a good HVAC guy, you stay with that guy forever. Those are very sticky businesses, and those are the types of businesses that we like. One of the ones that we had liked in the past is Healthcare Services Group, which is definitely not a household name, not a sexy sector. Their core business was in providing laundry service to nursing homes, so quite dirty business. But they were it was a highly fragmented market, but once they were in a nursing home, unless that nursing home had financial problems, they were basically holding on to that customer for life. I think they had like a 99%. 99% of the customers stayed on. So, I mean, it was just a very steady growth company. They were growing 15 to 20% every year for many years. But their struggle was that they switched. They decided to get into the food service business. And I don't think they were prepared for dealing with food prices going up and down and having to dealing with commodities and perishables going bad. So that was kind of their hiccup that they eventually had to deal with. But for a long time, it was just a great growth company.
Yeah, great company. And you're right. I think the hope there was that they wanted to cross-sell their cafeteria food into the existing clients that they had. And then they had a rude awakening saying, food business is different than the laundry business. So it took an adjustment. Let's go straight into segment 2.